All right, so let's go on now. We're going to start talking about an installment agreement now. The context of the discussion here is emergency measures to stop collection. The single best way to do that is file a timely CDP request like we talked about already. But you don't always have that luxury because it depends on when the client walks into your office and what stage of the procedure your client is in at that particular point in time. As I said, a lot of clients have blown their opportunity for a CDP hearing, and so now you got to try something else. So one of the other very effective strategies, and I'll tell you, this is something that almost nobody knows about. Getting back to the question I answered a minute ago, is when you read original source material, you discover things and you learn things that most people don't know. And this is important with respect to an installment agreement. Under the law, under the Internal Revenue Code, the application for an installment agreement stops enforced collection action. It operates as an injunction against the IRS from levying or seizing assets. And so this is a tool that you need to be aware of to help you stop collection action and get you into a position where you can negotiate with the IRS on behalf of your client. You need to use IRS Form 9465 to do this. I shouldn't say need, because any kind of an application for an installment agreement will stop collection action. If you put it in writing, if you call the IRS on the phone, which I don't recommend, by the way, but I do like to use this Form 9465 because it takes the confusion out of it. In the process of applying for an installment agreement, you're going to have to provide current financial information to the IRS. We're going to talk about that in just a minute. A streamlined agreement does not require information. A streamlined agreement falls into one of two categories. If your client owes less than $50,000 to the IRS and can pay within 72 months, you do not have to provide financial information in order to get that agreement established. If the client owes between $50,000 and up to $100,000 and can pay within 84 months, then again, that constitutes streamlined and they don't have to provide financial information. But financial information is typically an important part of the process. And so we're going to have to get into that. Now, as I said, collection is stopped while the application is in effect. And so when you file the request for an installment agreement, the IRS can't seize. If the installment agreement is accepted, the IRS cannot levy or seize any assets while the agreement is pending. So as long as your client is making the payments and living up to the terms of the agreement, the IRS can't touch them. If the installment agreement is rejected or terminated, which the IRS has the right to do in certain cases, then the collection remains stopped during the following 30 days. Now, I mentioned the CP 523 a couple of minutes ago. CP 523 is the written notice the IRS must mail to your client if they have rejected or terminated the client's installment agreement. That notice says very plainly that the IRS has terminated the installment agreement and that you've got 30 days to either pay the tax or file an appeal. If you file the appeal within that 30 days, collection remains stopped while the appeal is pending. So as you can see, this application for an installment agreement and this installment agreement process is a very useful tool for preventing collection action. It's actually an emergency tool. The installment agreement is actually an emergency tool, and it's a very effective arrow in the quiver that you can use to stop this action. Now, even if you don't think your client can ultimately pay off the tax through an installment agreement, that's not the point here. The point is we want to stop collection. We want to get the IRS into a position where we're negotiating with them to try to come to some reasonable resolution. What this does is it keeps your client from getting run over. So now let's move ahead now and let's go to the topic of how to get a levy released. You know, it's one thing to stop levies on the front end, but again, you don't always have that luxury. If the client comes in the door and they're already being levied, then you got to do something about that levy that's in place, and you want to get that levy stopped. And so how are we going to do that? Well, we're going to contact the IRS office that issued the levy. The levy came from one of two places. It either came from IRS's automated collection sites. This would be one of the service center sites where they automatically mail the levy notice out. It probably came from there. Or it may have come from a local revenue officer. If the client owes sufficient amount of money, substantial dollar amount, 6 figures of liability, or if it's an employment tax case like a trust fund case or a business employment tax liability, you're going to have a local revenue officer, a tax collector that's been assigned to the case, who's going to come out and execute that levy. So we're going to contact the IRS that issued the levy, and then we're going to go to the next step, which is to provide current financial information. In order for the IRS to release a levy, you have to demonstrate that that levy is causing some kind of a hardship or putting your client into a position where they're having difficulty paying living expenses. In order to prove that, you've got to demonstrate current financial information. For wage earners or self-employed people, you're going to use Form 433A. That's a collection financial it's a collection information statement is what it's called, collection information statement. And then if you're dealing with a corporation or a partnership, some kind of a business entity, you're going to use Form 433B. That is also a collection information statement for businesses. So the A is for individuals and self-employed people, wage earners and self-employed people, and the B is for corporations, partnerships, and so on. Now, what do these forms do? These forms report to the IRS the income, the expenses, and the assets and liabilities of the taxpayer. So the IRS can see what the taxpayer's capacity to pay is. The IRS will tell you when they're dealing with delinquent accounts, they're not a bank. All right, we don't set people up on installment payments if they can afford to pay the tax in full. So the IRS's first demand is always full payment. Give us the money now. And if the taxpayer says he cannot full pay, then the IRS wants this financial information. Show us your income, your assets, your expenses, and your liabilities. You're going to have to provide documentation of income and expenses for the last 3 months. So for example, if you're showing that your client's got 2 car payments, they've got their health insurance, they got their out-of-pocket medical costs, and they have their housing costs, you got to provide this information for the past 3 months to justify what these expenses actually are. Now, what the gist of your argument to the IRS, whether you're dealing with ACS or you're dealing with a revenue officer, the gist of the argument is that continuing the levy is going to cause financial hardship. It's going to put you into a position, or your client into a position, where they cannot pay necessary living expenses. The term hardship is defined in law as the inability to pay necessary living expenses. So just for example, if the client has $5,000 a month in income, and they've got $4,800 a month in living expenses, including their current taxes, and the IRS has taken $1,000 a month, obviously that client is in a very difficult financial position and does not have the ability to pay living expenses going forward. So there's the hardship. In my book, How to Get Tax Amnesty, in Chapter 6, I take you all the way step by step through the process of analyzing this hardship claim and showing you exactly what to do to prove this hardship. So in terms of continuing our argument here, you're going to have to establish what the client's disposable income is. The installment agreement is based on disposable income. It's not based on a payout period, and it's not based on how much they owe. Now let me qualify that, because I did earlier talk about a streamlined installment agreement, and I told you that if the client owes less than $50,000, for example, and can pay within 72 months, that the IRS will streamline the agreement. That is a streamlined agreement, and it's based only on the client's ability to pay the tax in full. If the client does not have the ability to pay the tax in full within that time, then we're going to base the installment agreement on disposable income. Disposable income is the difference between your gross income, all necessary monthly living expenses, including your current taxes, and the difference is then disposable income. Using my example of the client that had $5,000 worth of gross income and $4,800 worth of wages worth of expenses, $5,000 in wages, $4,800 worth of expenses. In that case, we've got $200 a month disposable income. And even though the client might owe $50,000 or $100,000, obviously $200 a month is not going to pay that off in 72 months. It's not going to pay it off in 84 months, but it doesn't matter. At that point in time, $200 becomes the installment agreement amount, because that's disposable income. I want to emphasize that the statute controlling the installment agreement, which is Code Section 6159, by the way, does not mandatorily require that the tax be paid in full under the agreement. Okay, it requires requires that it be based on disposable income. Now, the question is, what if there is no disposable income? If there's no disposable income, you can request what's called currently not collectible. This is a situation where the IRS pushes the hold button on the taxpayer's collection account. They put it on the back burner, and then they do not require any payments to be made. And that C&C status, as we call it, is reviewed periodically by the IRS. And if the client's circumstances have changed considerably in let's say 2 years or 1 year even, then the IRS will reevaluate it, and at that point in time may require an installment agreement at that point in time. In order to establish currently not collectible, you've got to prove that your income and expenses are such that you cannot afford to make any payment to the IRS whatsoever. And so in that situation where you're arguing for C&C status, the IRS is going to scrutinize the income and expenses very carefully. Along those lines, they're going to want proof of your current income. If you're self-employed, you're going to have to show bank deposits and provide your bank statements for at least the last 3 months. Normally, they're going to want a profit and loss statement, year-to-date profit and loss statement. And for wage earners, they're going to want a year-to-date income statement to show what the income is. And then, as I said already, they're going to go through your expenses very carefully.